very excited to be hosting this group today, and let me just do a big thank you to John and the rest of the group here to put on such a great conference. So thanks everyone. We've got an exciting chat about what are investors looking for today, and I think I just want to start off and have each of you introduce yourself. Start with you, Kat, and tell us a little bit about your firm.
Hi, Kat Zing. I'm a partner on our early stage fintech team at Lightspeed Venture Partners. We're a multi-stage fund with early stage roots, and really excited for the discussion today.
Hi, everybody. Kerry Ransom. I run a firm called BankTech Ventures. We're a 4-year-old strategic investment fund for the banking industry. So we have about 120 banks across the country that are limited partner investors in our fund, look to us to really help them identify the emerging technology companies like many in here today that can help their banks be better. And so that's what we do. And then we ultimately try to invest in the best of the bunch.
Nick Milanovic. I manage a tiny fintech venture fund, very creatively called the Fintech Fund. We sit at the opposite end of the spectrum from Lightspeed, I would say. We're not multi-stage, we're pre-seed and have 20 million under management. We do non-lead checks, but have had the pleasure of investing with a lot of this group for a few years now and really excited for this conversation.
And hi there, I'm Susan Ehrlich. I'm a partner at Core Innovation Capital. So we're an early stage investor looking in the areas of health and wealth. So we think of the market space that we're trying to cover as areas that represent large household spend, where demographic shifts are kind of creating tailwinds behind opportunities, and frontier technologies are disrupting incumbents or creating the ability to fill in white space. And we're early stage sort of seed and Series A.
And I realized I forgot to mention that I'm Ryan Christiansen, and I run the FinTech Center here at the University of Utah. And I'm really excited about this panel because we have a lot of things happening kind of in the lab setting that becomes the early stage. And so being able to see the journey that these entrepreneurs can go on and start to engage with your firms. So I would imagine that over the last 18 months, as we've watched the emergence of AI start to actually get into implementation, that there's been a lot of changes in the way that you're investing or maybe viewing companies. And so maybe you could walk us through, each of you, how you've changed your view over the past 18 months and maybe what you're investing in or maybe some of the diligence. Love to hear your perspective. Let's start with Kat.
Yeah, happy to. I think the interesting thing investing in fintech is that at early stage startups, you talk a lot about product market fit, but I find in fintech, you already kind of have that. So really it comes down to other areas of like product marketing fit, like how are you owning distribution? How do you have an interesting entry wedge? So I think the way that we invest in early stage fintech startups hasn't really shifted too much, but I do think we are taking a deeper look on the technical side, whereas how have you thought about building your product architecture? Are you AI native? Or if you were ahead before kind of LLMs, how have you evolved the business model to take in more AI-focused technical architecture in order to kind of power the business or like add more fuel to the fire. So I think that's broadly how we think about it at Lightspeed.
I think for us, it's been super fascinating because we're seeing some macro trends. We start with sort of the bank and the bank market first and what's happening in banks. And so just a couple things that sort of macro changes. One, there's an aging demographic, not only of bank customers, but also of bank staffs. And one of the things that they're smartly starting to recognize is we're not going to be able to convince people to come work here if our underlying technology in the bank is older than the employees that we're trying to recruit. They just simply won't come. And so some of the things that are driving their interest in adopting new technology is actually just a survival of we can't have a bank if we don't have people that are willing to work here. So it's been fascinating to see that open-mindedness to, okay, we're going to have to replace this 20-year-old or 30-year-old system, where do we go? Do we go to something that's only 10 years old, or do we move to a completely new paradigm of AI native or something that maybe feels a little bit out there? But as I tell a lot of them, the good thing about the fact you haven't been so cutting edge is the cost of this continues to come down. And so you're at an advantage. And so as we think about investing, we really are trying to gauge their capability in what they can reasonably bring into the bank and be successful with. So it's really for us a matching. And so in some cases, as we're seeing AI, it's happening inside the company trying to deliver the product or service, but the end product may not yet be an AI agent, for example. It might be a tool. And that's fine because the cost of delivery or cost of building or speed may be where AI is really helping them today. In other cases, it's we're going to replace an enterprise system with a series of AI agents, and we have to help the bank get comfortable that that's going to be the next phase of the product. So we're in a really interesting inflection point, I think, in what the software stack is going to look like in banks. And we spend a lot of time really trying to think through that. And I can't say we have it all figured out, except I know it's going to look very different 3-5 years from now than it does today.
And Nick and Susan, I'm going to add a little twist to the question here too, because I'm sure you have some portcos as well that you're looking at them through a slightly different lens than maybe when you first invested. And so as you're looking at new companies as well as portcos, is that having an influence as you think about AI?
Well, that is a good twist. This is where I get to plug all my portfolio companies. So does that mean that this is the year that banks are finally going to get AOL Instant Messenger?
Maybe, yeah, exactly.
One of my favorite analogies thinking about kind of where we are in the AI cycle is that when electricity came out, homes in the US electrified relatively quickly. Like consumer electric was very obvious, people got light bulbs, but it took factories another 30, 35 years to electrify. And the reason for that isn't that people didn't try to introduce electricity into factories, they did, but all these factories had old machinery that wasn't built for electricity. And so it's when they started rebuilding the factory stack from the ground up for electricity and throughout this steam-focused machinery that they're able to actually leverage that efficiency. And I think we're kind of going through a similar period now with AI, where a lot of products are, old product or existing product plus AI on top of it. And we're kind of, trying to retrofit AI into old products. And so we've been pretty slow to invest in the AI space. Partly that's because of valuation sensitivity, and that's why I'm still flying economy to these conferences and taking red eyes instead of sitting on, $3 billion gains. But partly it's because I think we're seeing a lot of competition to apply AI in ways that isn't really groundbreaking. And so the times that we do get off the bench and invest are usually when we see people who are doing things that weren't commercially viable before they introduced AI into the product, or building things that weren't structurally possible before LLMs became broadly accessible, because that actually ends up being materially disruptive to existing providers in the space. And so to your question about portfolio companies, AI is a platform like any other platform, internet, mobile. And so, for our existing portfolio companies, we've invested in a couple of KYB tools. And there are 3 great KYB or KYB adjacent providers just today who pitched in the demos, all building really interesting stuff. And a lot of it is agent-based KYB. And so we're talking to our KYB portfolio companies and saying we have to think about how you can use agents or use LLMs to make your product more efficient. It's not a choice not to be an AI company anymore. Everybody has to make that transition.
Yeah, and I'll build on that a little bit. So, in terms of how it's affected our decision-making on investing, I think we're going broader in terms of the opportunities that we're looking at, because there are, again, as a foundational technology, it's disrupting or creating the opportunity to disrupt in a lot of spaces. So, we're looking at housing, we're looking at insurance, we're looking at healthcare. We've sort of broadened the mandate around health and wealth because we just see these are regulated spaces and the opportunity and potential is great. And we're also going earlier, and that is a function of where some of the raises at a Series A and the valuations at Series A's have gone. And so we're earlier and writing more seed checks than we have historically. And in terms of looking for, TAM is known, founders you meet and get a feel for, what we're looking at in business models is access to proprietary data. Answering the question, where's the competitive moat in this? And how can we be guaranteed with everything that's changing as dynamically as it is, where do we think there's bets to be made that will sustain and be durable over time? So what access to proprietary data do you have, or can you be creating in what you're building? How deeply integrated are the workflows that you're providing to make the decision to rip and replace like really hard to do for a client? And where are the advantages in distribution that really give you a leg up on the cost of acquisition? And those things have to be present. And we see a lot of companies that sort of don't pass the bar on those questions.
Yeah, and to dig a little deeper on that one, is the defensibility or the moat changing because of AI? Are you seeing that in your analysis right now? Go back to Susan, you want to take that on since you started it?
Yeah, I mean, I think I think these have been harder questions for founders to answer, and we go back at them a couple of times to be sure that we have confidence in the answers that we're hearing. And I think these are challenging questions for people, but they're also at the early stages of building, and so we see evolutions happening in their business models, even in the course of the conversations that we're having. So I think people are getting religion around it.
Yeah, go ahead, Nick.
I mean, just to build on that, because I couldn't agree more. We talked about this a little bit in the preview call, but it does place a greater emphasis on being an effective sales team and effective with your go-to-market strategy, because the defensibility of being able to rest on building the best tech is lower in an environment where it's pretty easy to replicate different products across companies.
Yeah, I mean, the dissonance that I feel like we all have to contend with, that I struggle with too, is like you have these companies right now that, generally it's like they're getting overcapitalized or more significantly capitalized than we've ever seen, which generally presumes that there's like a winner-take-all outcome, and it's easier than ever to start. You're seeing more Me Too's, and it's easier than ever to start these. It's less expensive to start these, and so those don't actually fit together really well. It doesn't get talked about because you have capital is driving some of these we have big funds, so we need to deploy big amounts of money, so we need people to believe that they can go do it. But to your point, like if you're marketing and selling to banks, it's just blocking and tackling and being in the trenches doing it. And you can deploy an army, but until you have a motion that works, it's not necessarily worth doing. And so there's a lot of dissonance right now, and I look at it and go, if I were going to start another company today, I would probably do it with little capital, because I'd have a very high conviction on how I could go build a $5, $10, $20 million a year business, and then maybe on that trajectory, I discover something much, much bigger, but I could capitalize it, so I'll do fine. Yeah. And I think that's not getting encouraged enough, where people are celebrating. Like if my round isn't as big as others, then I'm not a legitimate founder. And I look at it as like, if you can go solve real problems in the world, in the financial system, there's plenty of opportunities, but those don't get, or they get overlooked, right?
And what I'm hearing from Nick too is like you need to also be able to sell into the financial system, which is very difficult, generally very long, and your moat can't be, I'm going to hire tens or hundreds of the best coders, because AI might be the best coder, and you don't need to hire tens of hundreds. So any other thoughts there?
Yeah, I just think, I mean, at the earliest stages, like there is no, like there are no moats. I think a lot of the moats that you build over time is the same tenets that we have when we look at early stage founders, is like, do you have a differentiated edge into a network, or a way that the way that you build your product is unique? There's something that it's spiking that gives you additional leverage that compounds over time that allows you to build that moat. I do think depending on the type of product you're building, today if you are fully AI native and you are going after trying to be like, go up against something that's like a verticalized LLM for financial services, it'll be expensive, right, from a raise perspective, and you won't want to probably try to go after the best AI researchers. So it really depends on the business. I agree. I think raising for the purposes of raising is never the right motivation. But I think as you think about where you can add levers to have your business build a viable moat, that happens primarily at the early stages from a talent perspective and speed. Like that, those are the things that you have that allow you to be differentiated against just as smart founders who are building in a very similar space.
I'm going to move on to thinking about banking a little bit more directly. We have quite a few bankers in the room, and God love you. You've always had this mentality, it seems, to build versus buy. And I'm wondering, especially Carrie, are you seeing any changes in that mentality when it comes to AI types of products? Is there more of a shift towards we want to buy versus build, or is it not changing at all?
Yeah, and I would say, there are very few banks that actually build. It's that upper echelon of banks that build, but most are totally buyers. Like I have plenty of banks that are in our fund that don't have a single technologist, as we would all think about it, in the bank. They have maybe an IT team or at least technology team, but they're vendor managers, and they're making sure that the vendors are held accountable, which you need to do, obviously, but it's total reliance on third party. Unfortunately, for a long time, it's been total reliance in many cases in small banks on generally one third party. And in essence, their core vendor has almost run the bank. And so what we've been in the last few years is an era of, I will call it, reducing reliance on the core. So they've started to understand we need to broaden out and adopt some best of breed solutions. The core that conceived the bank as the customer is probably not the best company to deliver you the customer experience to your end customers, as an example, right? And so you're seeing those things start to split. I would actually like to see more banks getting into the business of building some things that they feel like they can differentiate on. And that's a change, because now you have to start thinking about, okay, who do we need to have in here to be able to build digital products? And maybe that means we're taking the bank outside of the bank and embedding ourselves in our customers. And that is a new capability that most don't have, but I think will become more of a requirement for more banks that want to remain independent.
And you're definitely seeing a little more competition at the core level, where there's people like locally you have Loan Pro that's doing loan systems, right? And so I think maybe starting to see some specialization in what typically has been delivered by the cores. Maybe that's the direction things are going. But other perspectives on build versus buy and
Well, I less on that, but something that came to mind as you were talking about the challenges of selling into banks. This is an area where, like, we have started companies that we really strongly suggest that they build advisory boards. Like, the ability to sell into a financial institution, as you all appreciate, is very nuanced and very relationship-based. And I think it becomes really, really important to have people who have been through that experience to help explain to you what this is going to be like. It's not your typical technology sale, and I think a lot of them go in expecting that it's going to be a lot easier than they find it to be, and being able to collaborate and work with advisors who can coach them on how to position their message, how to answer questions effectively, and to build confidence and trust in their teams and their solutions, I think is critically important. And I would highly recommend that if you're building for financial services businesses and you don't have an advisory board, you consider that to be a takeaway from today.
Great advice.
Nick, Kat, anything you'd add there? Okay. We've heard a little bit today about some of the problematic natures of AI, in that it's probabilistic versus deterministic, and that can be a challenge, especially if you're looking at technologies that are going to go into the compliance area, which seems to be where there's a lot of early action. Have you had any views around that in some of the companies that you're looking at, how they're approaching some of the maybe differences that you see between what the approach has traditionally been versus what AI is offering? I'm just interested in maybe your perspectives there.
I think we've seen, specifically for like, I would think like for banking, we've seen a lot of like shift from what was, I think human in the loop is still very prevalent, regardless if it's a workflow tool for compliance, KYC, KYB analysts, or which was kind of the era before AI, and now we're seeing what is AI agents that are doing that, but you still require kind of like maybe like a KYC manager to do that final sign off. Really, I think we're in the early innings around adoption for FIs. I think there's still a lot of trust that needs to be built. We've even seen, I didn't respond to the last, but like even from the buy versus build, we've seen actually another type of distribution model, which is kind of akin to like the Palantir model, which is like a forward deploy engineering team that goes into the bank and says like, hey, we're going to build alongside your tech team and we're going to help you implement this solution. And the core purpose of that, as we think about it, is you're building trust. You are building viability and trust in the saying like, hey, regardless of the output, which we ideally think will get to the same place and we'll be able to cover more with the AI agent that we have, we want you to feel as the buyer and the customer that you're in a highly regulated industry. It's very important that you feel 100% confidence in the product that we have. And so I think that's really the angle. I think when we're looking at the difference between what was like workflow automation, SaaS, and then today, agentic AI, like workflows.
Yeah, I mean, go ahead.
No, go ahead.
Imagine talking to your chief compliance officer and saying, we're going to implement a customer management chatbot that hallucinates only 5% of the time. The conversation ends right there. I think it's difficult with probabilistic tech in a highly regulated area. You want to be able to have a product where it's very determinative. And so this, places an emphasis on creating that additional secondary layer on top of available LLMs to really make sure that you have, a few things: predictability, auditability for decision making, which is especially important in fraud and credit, and customizability to fit your own bank's policies and procedures and requirements, as well as being accessible to non-technical users, because a lot of times when you're working with a bank, you have to pair the engineer with somebody on the compliance team, somebody on the credit underwriting team, but like being able to have people who are actually subject matter experts sitting on these tools, I think is really important. And so that's a great opportunity for fintech companies, is to basically sit between available LLMs and their regulated customers and be able to actually give them a little bit more of a predictable tool. And I think we're in very early innings of seeing that. Carrie, you had mentioned that if you're a bank, you may choose to build to be differentiated. And I think, my suggestion here would be that banking is a really great business. There's not that many issues with banking as a conventional business model, and it's relatively undifferentiated, at least on the consumer banking side, and that's okay, because the business works really well. Dasani and Aquafina and Poland Spring can all afford to sell water, and they're all viable businesses, even though if you open them up and do a Pepsi challenge, you're probably not going to taste the difference. And so, I think if you're a bank, in most cases, it's not necessarily to your competitive advantage to bring in-house an AI team and build. There'll be the exceptional case where you're like really trying to grow assets and you're trying to grow your regional remit and you want to strike a partnership with Cash App where your banking services are available in the Cash App when you pull it up. Okay, outside of that, I think in almost all cases, your competitive advantage is being a bank and you want to work with subject matter experts, and normally that's forward deployed engineers at other teams, or it's companies that have really built up this third-party vendor expertise. And there's some liability reasons that you may want to work with third parties as well, rather than building it yourself. And so I think AI is going to I personally think AI is going to present this entirely new vector for bank fintech partnerships that makes me really excited. It makes me excited to be an LP in bank tech, to be totally honest.
I generally agree. I totally agree. I think it is, if you have a vision for differentiation, how can you go deliver on that? I think, and it may be still better to partner. I mean, you see, the banks that have gotten heavily, including a number in Utah that have gotten heavily into partner banking, where they've benefited in many cases, which again doesn't get discussed a lot, is they've benefited from the fact that investors have put tens, if not hundreds of millions of dollars into the fintechs they partner with, which are subsidy marketing budgets that the banks would never otherwise spend. And so they're getting the downstream benefit of that when they're successful. And so that's been a partnership model that has worked, and I think we'll see new ones. I agree. The couple of things around your question that I think we're seeing as an example that the probabilistic deterministic one, where you can teach somebody. I mean, we've had RPA for a while. Only about a third of banks implemented RPA, which is shocking because there's so much task repeat that happens. But you wouldn't bring RPA into your bank today. You would get some sort of agentic AI solution, which could still be pretty deterministic in how you assign it to do work. And it could operate on top of existing systems. And I think that's our interim answer until we can get to a place where we start atomizing process down to almost a blank sheet of paper and say, okay, how would we design this from scratch in the world that we now have with the capabilities that now exist? And we don't have many banks there yet that are ready to start reimagining from the ground up, recognizing what new technology exists. But an example I use a lot is most compliance, most fraud in smaller banks is after the fact, it's sampled, it's reactive, and we know in a world that we're in now, it needs to be in-stream, proactive, real-time. If we're going to have faster payments, you've got to have those controls in place, or else you're going to get hammered, right? So the kinds of work that AI enables, as Nick was saying earlier, are things that you just weren't able to do before. The economics didn't make sense. You had to do sampling because it was manual and you had to have people do it. Now the economics have changed. What work can get done? So that's the exciting part.
And the thing I like about the seat that each of you hold is that you see so many companies that are coming in to pitch to you, or companies that you've invested in that you're helping to advise. And so what would be the advice that you would give to an AI company today that's kind of got this blank sheet of paper, right, in a sense of what should I be thinking about right now? So what is that advice you'd give? And I'd also like to maybe add a component there that is also, you've got these portcos, you're looking at other companies. What's the advice you would give to bankers as they're looking at those companies that you look at? So we'll start with you, Kat.
I know I'm trying to think what is like at the early stage that isn't like stay focused and yada yada, all that, like the classic at the early stage. I think it's like how you do everything, or how you do anything is how you do everything, and really right now what is our team keeps on coming back to this, which is like, especially in traditional FI, and if you're selling into it, is distribution is king. So I think as you think about your go-to-market motion, like really be laser focused on why your customer is buying or why your prospect is saying no, and understand that a no is actually the best feedback loop for your product, and go after that and go back to that prospect and try to keep on refining. I think the iteration loop and getting as many no's as quickly as possible and then running through them is something I would highly recommend for any early stage company that's building, particularly in this space. As I think it on the other side, like the customer side of it, I think very similarly, understanding and building the relationship with kind of these vendors that are coming to your doors, and watching kind of how they show up, right? Like, you may tell them no, and how quickly do they respond to the feedback and come back to the door. So keep an open mind, and also keep almost like a trajectory loop of how that vendor has performed, because you will see that you really, like, what we invest in at early stage is like wanting the potential of high slope. So if you think about that as the vendor, you can guarantee that if you are choosing between 3 or 4, the one that has the highest slope is going to be able to grow and do more for your business than maybe the other ones that have come to the door. And so I would recommend kind of keep on reiterating that feedback loop for yourself as well.
Yeah, I'm going to start with that as just to build on, because one of the things I find a lot with our banks is they'll say, oh yeah, I met that company like 2 years ago. And I go, yeah, this is not fill in the blank core vendor. This is a startup with a slope. They are a totally different company than they were 6 months ago, let alone 2 years ago. So my advice always is stay connected with. If they were even remotely interesting 2 years ago, you should get on as regular a cadence as you can handle. The other is find your partners you can trust, because I mean, we meet somewhere close to 100 new companies a month. I don't know many banks that want to do that, and part of our job is to try to sift through that to surface the ones that they may want to spend time with. And so it's like find the partners that you can tap into. On the founder side, the advice I try to give, and I only get it about 50% of the time, I said, treat me not as an investor. When we meet, treat me as if I'm a buyer, because I am a proxy for several hundred community banks across the country that we have relationships with. If we can't understand it, then there's no way we're going to be able to translate it to them. And we're a little bit more knowledgeable about this than most. So treat us as if it's a total customer sale first, and you'll actually get farther in us being able to determine whether there's something here, which is unique.
Yeah, that's really great. Susan, you want to?
Yeah, and I would say, we spend a lot of time coaching founders on, like, they fall in love with the problem, and then they get a little bit too much on the send mode of pushing their solution. And I think, back to some of the things that Kat was saying, like, you really need to spend the time to listen to the feedback you're receiving. And we've had companies that in the course of that, in that feedback loop, have discovered that there were things they built for themselves that actually turned out to be the better products for their clients. And so just being able to get into some of these conversations to understand, like, what are the problems the client actually has, and maybe I swung and missed on what I thought was going to be the right product or solution, but I might have some components of some things that I've done in trying to build that solution that turn out to be the platform that the client will actually need and use. And so we've got some companies that are building in back office workflows for insurance companies that were trying to build a front end solution, and all the things that they had to build for themselves turned out to be incredibly valuable. And so you may find in your review that in your discovery process, there's some things you built for yourself that you can build very large scale businesses around that are worth pursuing.
I'm worried about saying the same thing the fourth time, but I mean, can't double underline that enough. Spend more time with your customers. For AI companies specifically, there are two things I'd say. One is going to be kind of a rehashing of everything people just said, but spend time with your customers before you build a product. And specific to AI companies, because if you're selling into banks, guaranteed if you're building a bank vendor management product, there are probably 3 other companies going out there and pitching bank vendor management. Doesn't mean that it's a bad idea, but like talk to all those customers before you start building and figure out, like, if they didn't sign up with one of these 3 other companies, why not, and what problem wasn't solved. Because quick time to build a product means quick time for all of your competitors to build something that they can pitch against you. And that just wasn't really true before AI. So just know what your customers are seeing in the market and where the gaps are that you can fill. The second thing I'd say, and this is like, very selfish, and so please hear my tiny fund plea, but don't raise too much money up front. I know it's easier said than done, and there are these, quote unquote kamikaze rounds happening for AI companies. But the reason I say that is because early on is the most expensive time to possibly dilute yourself as a founder. You don't want to be giving away a ton of the company up front unless you really don't feel like you have great line of sight to what you're doing. What I've seen work the best is to raise enough money to get where you think you need to be to hit those first milestones for the next round, and then a little bit more to give yourself some cushion to miss, maybe more than a little bit more if you think it's relatively speculative what you're doing, and then just do a bunch of low-cost experiments. Like, go crazy. Try to figure out like 100 things while you raise that capital because you have a little bit of a runway to figure it out. And then as soon as you get the data point that shows you, A, people are buying this, is flying off the shelves, or, B, we have something really interesting here that's resonating with people, but we just need a little bit more money to actually build it out. Or C, like after a ton of experimentation, we finally figured out what sticks, and now we're gonna like just hone in on that product. Like those are kind of the three signals that give you a good opportunity to go out and really own the narrative for your next fundraise. And if you do that a couple times early on, you'll get to a point where you have a product that your customers love and are willing to pay for, but you won't have diluted yourself so much up front, and you'll be in a much, much more admirable position, an enviable position as a founder to be able to kind of raise on your terms. So that's my one plug.
You know what I really appreciate about those answers too is if we asked that same question a year ago or 2 years ago or 3 years ago, I'm not sure those answers would change a lot. It's really the fundamentals, right? And the AI is maybe speeding things up a little bit in some cases, and absolutely there's some very cool tech that's coming out of AI that we haven't seen before, but we still have to worry about the fundamentals. And so with that in mind, let's do maybe the bonus question of where's AI being overhyped? I mean, you have to see that all the time, right? So I'd love to, let's do the, where's it overhyped?
Yeah, I'll start. I think it's potentially real, but I think it's, overhyped right now is what are the business models really changing? There's a presumption, as an example, that AI agents are not going to just consume software budgets; they're going to consume labor budgets, and there's a much bigger sort of opportunity within an existing business. And I was actually having this as a sidebar conversation earlier today. We don't know what percentage of that they'll capture, right? Because it is a competitive market, and if you look at history, usually when there's a big breakthrough, maybe the stabilized value capture is like 15% of what the upside value. So if you think of 100% pie of labor plus technology, maybe labor is 80% of that today. And so, you can start to maybe hone in, but I think right now some of these are getting underwritten as if they're going to capture 100% of that total value forever. And I think those are the things that we're going to have to see normalize over time. And so even as a somewhat risk-taking person, I still look at it and say, I'm more aligned with Nick around, like, start to prove some things out before you really step on the gas, because you're just going to have a better chance at a positive outcome.
We got to have some more overhyped than that.
Belief that there's revenue traction, I'll just build on that. Like, belief that there's revenue traction in this business opportunity that you see that's going to be sustainable and durable over time. And I think that's the biggest, I hate to say it, like overhyped thing right now is I think it's too soon to tell. And I think bets are being made too big too soon on what is not enough signal yet to say that there's a sustainable, durable business to be built here. So I would say that's a place where, the traction piece of it still needs to be proven out. And I think people are betting on a belief that early signal is enough, and I don't think we're there yet.
Yeah, I'll plus one that. I think it's never been easier to land a customer that you couldn't get into from like a B2B SaaS perspective, but it's the question around how sustainable is that revenue, and also can you actually expand into kind of a long-term, like the amount of like, we'll just use like a, AI chatbot for investment banks. The amount of banks that are trialing 3 or 4 solutions because there's 20 of them out there, and they're all piloting and they're all really meaty contracts. These are like 6-figure, 7-figure contracts, but I'd be really curious to see how retention cohorts look in a year or 2. So yeah.
Nick, do you have some thoughts there?
No, nothing to add. I think those are 3 great answers. It's probably all overhyped in the short run and underhyped in the long run.
Right. That's totally.
Nice
All right, well, I think we're at time. Again, thank you, John and Spring Labs, for a great conference. I've had a great time with you guys, and thank you very much.
Thanks, Kyle.